Hi, I'm Iain Pyle, co-manager of the Aberdeen Equity Income Trust.
And I'm Thomas Moore, co-manager of the Aberdeen Equity Income Trust.
So in terms of income growth, we've continued to see strong performance across the portfolio over the last 6 months. And part of that is underlying performance. Part of it, as ever, is just moving our positions around, trying to maximize that income and finding stocks with still good distribution yields. If we look at the underlying portfolio, then it's been pretty consistent. I think if you were to draw out a couple of areas of good dividend growth, then certainly the banks in the UK, we continue to see good distributions there. If we look at, for example, Standard Chartered, which raised its dividend by about 50%, and also some of the industrials, so the contractors in the UK, they're names which continue to deliver good dividend growth. So I think Galliford Try was up 18%, Balfour Beatty up 20% this time round. So really good, solid growth in those names. And what we're seeing is generally those are sectors where you've got businesses where the underlying performance is really humming. They're generating good cash flows, and they're in a position where the balance sheets, in the case of the contractors, or the capital position in the case of the banks, are really solid. So as that cash flow comes through, the ability to distribute out that to shareholders at a greater rate is really, really strong. And I think generally in the UK market, we've come through that period where more has been allocated to buybacks. That's allowed the actual distribution payout ratio to fall to a pretty low level. And most companies have that ability now as they grow cash flows to increase dividends. And I think we're seeing that in the portfolio.
One of the key hallmarks of the Aberdeen Equity Income Trust is the significant yield premium we are offering to our shareholders. The UK market trades on a dividend yield around 3%, and we are trading on a significant premium. But it should be said that that's completely consistent with our investment philosophy. Iain and I are looking for mispriced opportunities, many of which are generating fabulous cash flow coming through in the form of dividends, while at the same time, a lot of companies are buying back shares. And the net effect of this is as these companies deliver strong cash flows, we're getting paid really attractive dividends, but at the same time, the companies are growing their dividends. And we're seeing the benefit of all of that in the form of rising share prices. So we believe that it's completely consistent for us to be delivering this attractive dividend yield at the same time as eking out growth in our dividend per share year after year. We are a dividend hero, according to the AIC. And importantly, this is not at the expense of our share price, which continues to motor ahead.
So performance from the trust continues to be really strong, which is great to see. I think at a top-down level, actually, that's come despite some headwinds for the portfolio because we're probably more leaning into UK mid-caps and smaller cap stocks in the UK. And that's actually been a pretty tough environment. But what has really worked has been finding stock-specific cases where we see improvement, where we see positive change, and where we see good valuation opportunities. Those areas where the market doesn't yet appreciate the positive dynamics in those stocks. And the challenge for us now is to keep that going, to keep nimble, and to get onto the next wave and find the next sectors where there is that valuation opportunity, where there is improvement. And I think when we look out from here, actually we're getting more positive on what the UK economy can do. And we're still finding sectors within the UK, particularly around construction, for example, where you can get some great businesses with long-term growth potential, but where the market sentiment at the moment is really negative, and that's creating some great opportunities. So it still feels like, despite the outperformance, it's a really opportunity-rich environment for us. I think that probably leads into the greatest risk for investors, which is probably the concentration of markets at the moment, that reliance on particularly tech, particularly US large cap tech, to support market levels. And I think you can build a case as to why it makes more sense now than it has done for a long time to diversify more and to find those next opportunities, find those undervalued gems. And that's certainly what we're trying to do.
Our focus on valuation isn't just an abstract concept. it's actually helping to drive the results that you're seeing today. Because by focusing on valuation, we're able to identify companies generating strong cash flows, using those cash flows to pay the dividends that you, our shareholders, expect, whilst also doing share buybacks, which are helping the share prices of the companies we're investing in. And importantly, that's also attracting the attention of overseas bidders. So already this financial year, we've had 2 bids, DCC and EasyJet. Last financial year, we had 3 bids. The financial year before that, we had 4 bids. So you can see that this is becoming a theme. And by focusing on valuation, Iain and I are able to identify companies with that optionality, where the UK stock market has failed to see the value that we see, overseas bidders are stepping in. And so it's with all of that in mind that we're looking forward to the period ahead with real confidence. Our investment process, Focus on Change, encourages us to meet companies and do the work at the company level. So Iain and I are spending the bulk of our time thinking about stock level opportunities. But of course, there is a huge amount of change in geopolitics. We've seen increased interest rates over the last 5 years, and we've been ready for those changing circumstances. We were able to go long banks, so we will have a very strong position in financials, including the banks. During that period when interest rates were going up, that was a great period for that sector. Same with commodities. We saw a strong move up in stocks like Rio Tinto. And if you have a look at our top 10 at the moment, you can see that there are plenty of companies that are thriving in what's quite a tricky environment. So our approach is to be nimble, to be able to respond to changing conditions while all the time keeping at the root of our investment process, that focus at the stock level.
So 2026 has definitely been the year so far where the adoption of AI has come to the corporate level and it's had a real impact on markets. And I think this transition of businesses into a much more AI-enabled world is something that we're going to have to get used to. It's going to have a really meaningful impact on the companies we invest in and their relationships with their customers and how they make money over the long term. For a lot of the sectors that are particularly impacted, it's the more high-tech sectors. So in the market, those are things that have been more highly rated. The market has always thought that they are going to continue to grow cash flows out into the future. What has happened this year is really that impact of AI has caused the market to question that reliance on long-term cash flows. Are these businesses still going to be here and not be disintermediated when we go 3-5 years out into the future? So that's led to a significant derating of quite a few businesses, but particularly software companies. For us, we've traditionally been underweight the software sector because it's not an area where we find the right cash generation and the right dividend paying to really fit our process. But this really creates opportunities. And one of the things we try and do is always be very open-minded about where we invest and try and be nimble to move between sectors over time. And of course, when you get this kind of sectoral shift and a derating, you get some companies thrown out which are genuinely challenged. You get some names in that mix which actually will thrive in this new AI-enabled world. And our job is to kind of go through the sector, find things which we can buy at a much cheaper price than we could have done 6 months ago, and where we still see a really strong business with strong cash generation just now at a cheaper price. So when we go through the sector, we've got to be very careful about the names where we want to invest. RELX is an example of a business where it's got a track record of moving through technological change extremely well in the past. It's got scale, it's got excellent customer relationships, it's got a good balance sheet, and it's got top-tier management, all the things which will kind of work in its favor as we go through a period of change. So that's one where we think, we can't be sure, but we think on balance of probability, it's got a good chance of succeeding. Another example would be UK IT reseller Softcat, and that derated with everything else at the start of this period. But our view is that actually UK companies are going to need to invest more and more into technology over the next few years. And they're probably going to need more and more help to do that in an effective way. And that's a perfect environment for a company like Softcat. So that's a great example of where we think the market has moved too quickly, and actually there's some real value there, a real opportunity for us to buy some growthy businesses at good valuations. So one of the results of the merger with Shire's Income is we now have this increased flexibility in portfolio construction, so we can hold fixed income instruments. And what they bring to the portfolio is more defensive high yield. So you have this great potential to add high levels of income, which will generally be more defensive through cycle than from equities. So at the moment, it's a relatively small part of the portfolio. We can go up to 20% as a hard limit. I think our inclination is probably to be below that over time, because if you extend your time horizon, long-term returns from equities are generally better than fixed income. So we want to focus on the equity part. But there will be a time in the cycle where maybe we see equity valuations as more full, we see yields compressed on equities, where actually adding some of that more defensive fixed income exposure is a really useful tool in portfolio construction.
Iain and I have been working together since 2015, here in the same offices. We know each other well. We understand how we think. We share the same mindset on income investing. And what this has done for us is it's enabled us to come together with the two income portfolios, Shire's and Aberdeen Equity Income, and turn over every stone, considering which are the instruments that we need to own in order to generate the best possible total return going forward. And so that's been a laborious process. We've made sure that we are absolutely clinical, and the end result is a portfolio that we believe is match fit. It's got the potential to deliver that yield, it's got the income growth, and we believe it's got that re-rating potential. Companies that are delivering really good cash flows, which should be on higher valuation multiples. So we're confident, and the reason for that confidence is that we're coming in every day, discussing the stocks between ourselves, but also with our team of analysts. And it's that competition for capital, which is making sure that this portfolio is set in the right place for the current market conditions and into the future. Thank you for watching this video today. If you would like more information about the Aberdeen Equity Income Trust, please visit our website.